welcome to all of you this evening. To our knowledge, this is one of the first such seminars that has been organized and held in South Africa on this particular subject, and we are very proud to be hosting it here at the Wits Business School. More importantly, we are very proud to be and honored to be hosting Dr. Theodore Panagioditis, an expert in Eurozone sovereign debt and a faculty member of the University of Macedonia, Thessaloniki in Greece.
So, today we are going to look at the literature which is evolving. It's a very, very new literature, which is looking at how basically social media interact with the financial markets, whether this is the stock market or whether there is spreads in the sovereign debt market. So we're going to see how this real-time information is basically evolving, interact, and cause everything that is happening in the stock markets and in the financial markets. Immediately stock prices dropped, and we have a 130 billion direct, immediate loss in the stock market as a result of this very, very simple game. So the social media is a storehouse of very important information that can contribute, that can help us to explain, maybe to predict what is happening in the financial markets, because they reflect real-time information. It's happening now, it's reflected now on Twitter, on Facebook, on a blog, or whatever. The same also holds for currency market. There's a paper by Smith in 2012 which shows that searches on Google on exchange rates also help us predict movements in exchange rates. So it's not only stock markets, it's exchange rates as well. Search activity on the internet is also helping us predict residential home sales. And this is obviously a much less liquid environment, but online search has been found to help us predict activity and price changes in the residential market. So it's not only the academic literature, but the financial press is also using this information, is advising investors to use this information. The type of information that travels very quickly is usually bad news. Bad news, not necessarily correct ones, as you've seen earlier. Bad news are traveling very, very quickly. What they do, and this is something very, very interesting and important, is they create a new index which they call fears. Okay, fears. What this index is doing, fears, is basically an average of all the Google searches of words that have a negative, that are negative. Things like recession, unemployment, bankruptcy. So this type of indices that reflect sentiment basically, and they do that in a real time, they help us in two very important things for the financial markets, which is returns and volatility, which, as we all know, is very, very difficult to predict. What are the determinants that can help us explain the cost of borrowing for each state? This market, the public debt market, is slightly more bigger than the stock market. And as the debts of all the countries are growing, this market is becoming more and more important. In fact, the projection is that the public debt market is going to become considerably more important than the stock market in the next 10 years. This is a very important market for a number of reasons. The first one is that the cost of borrowing for a country is very important for the future growth of this country. This is the first reason. The second reason I'm going to show you later is that the cost of borrowing for each individual countries influence the cost of borrowing that the private sector is facing in the same economy. So in the Eurozone, what we have in the last 4 or 5 years is that countries in the north, they borrow with interest rates that are really, really low, and countries in the south, we have countries that they face a really high interest rate. Is this affecting only the states? No, it's affecting the private sector. So the literature says that a 1% increase in sovereign risk translates into 50 basis points increase in corporate risk. Now, what we did in this study, I'm not going to bore you with the technical bits, but we employed a methodology which has some advantages. You need to start by looking at keywords on Google and then try to calculate correlations of these keywords with other keywords. What we usually do is we start with words like Greek crisis, Greek debt crisis, Eurozone debt crisis, etc. And then through the relevant service in Google, you get all the words, the keywords that correlate with these key phrases. And the benchmark is the German government bond yield. Why? Because this is always the lowest. Germany is always borrowing with the lower interest rates. So these interest rate differentials, for those of you that don't know, in the beginning when the euro was introduced, they were really small. So you could measure them in 100 on 200 basis points, which meant 1%, something like that. Okay, they were really low. But after the crisis in 2007, spreads began rising, increasing very quickly. So this is what we want to explain. We want to explain spreads. Why some countries borrow with lower interest rates and why some countries borrow with high interest rates. So we're going to try and explain this, and we're going to use whether what is happening in social media really is affecting interest rate differentials, spreads. So you can see the spreads are really high. The interest rate differential is huge. You can see this is Ireland, sorry, this is Portugal, this is Ireland. Spain and Italy are almost moving together most of the case. It's difficult to discriminate between the two. And these two lines that you cannot tell the difference between between the horizontal line is France and Netherlands. Why? Because their differences with the German interest rates are really negligible. They are very small. CDS is something that we're going to use in order to explain what is happening in the sovereign market, in the spreads. So CDS stands for Credit Default Swap. It is a financial swap agreement where the seller of the CDS compensates the buyer in the event of a default or in the event of what we call a credit event. If there is a default or a credit event, the seller needs to compensate the buyer. It's like insurance. The variables we condition on is the default risk, liquidity risk, Eurozone risk, and international risk. All these factors are taken into account. A direct test whether Google discussion is causing interest rate differentials, spreads. The other two lines, this one and this one, are measuring exactly the same thing, but this time we are taking into account the four variables I talked about earlier. European risk, default risk, international risk, etc. So what we observe is the following. When you see all this shaded period, here and here, these are periods where all the three of them point towards causality, point towards the fact that what is happening on Google, we haven't talked about Twitter yet, what is happening on Google is giving us additional information that is not contained in the four conditioning variables. So, the kind of conclusions that we draw are the following. First of all, there is a short-run causality from social media and Google queries affecting especially Greek and Irish spreads. We have accounted for all the structural forms, but we recognize that there is some underlying process here that we cannot quantify. This can be expectations, this can be animal spirits, as is used in the literature, or this can be the psychology of the masses, or something else. But this is obviously difficult to quantify. It looks like experts in the financial markets are using Twitter more, and this is reflected in our results as well. We have survey data that also confirm the fact that Twitter is more important in the financial markets. What is called a self-reinforcing waves of pessimism and self-reinforcing waves of optimism. So these are all have to do with psychology. It is difficult for us to work in a psychological framework because we're economists, we only like numbers, we don't understand anything else. But these are the things that we would like to quantify because they are going to help us explain what is happening. Okay, thank you very much for your attention, and I hope I will be able to answer your questions if you have any. Thank you very much.